Laura Hodges, MEPS steel market analyst out in the United States. Welcome back to the Speaking of Steel Market in Minutes podcast. It's good to have you on.
Great. I'm happy to be here. It was an exciting month last month, lots to talk about. And, data in the US is even starting to flow through again after our shutdown. And one little side note, we even have snow here in Washington, D.C.
Oh,
today.
wow.
So it's a good day to do all of this.
Yeah, yeah, absolutely. Feeling festive. Lovely.
Yes,
Uh,
exactly.
Well, what we'll do, as you mentioned, it's been an exciting month in the US steel market. A lot of that was reflected in the International Steel Review, MEP's regular publication. So we'll be drawing on some of that insight to give a summary of the US steel market in this Market in Minutes podcast. We usually start off with supply, so we'll not break the habit of a lifetime. Clearly, we've over the recent months we've become probably more aware, I think, of the effect that tariffs are having. I've been, increasingly conscious of that. Can you just give me a little bit of a summary of how that and the other factors are playing into US domestic steel supply?
Sure, of course. It's a great way to start this month. In particular, supply is always an important aspect to steel prices, but this month in particular. So generally speaking, I would say that supply really has tightened a bit here in the United States for a variety of products. Imports for flats and longs have dropped considerably since July when the tariff was increased up to 50%. Just to give a little numbers behind it, just for flats and longs, we were running at a monthly run rate of around 1.1 million. And in September and October, we dropped to about 800,000. And and I should say September and October are still that preliminary license data that's coming into the United States. And I am going to quote November even now, and that of course is also preliminary data. But it is looking with one more month, one more day in the month to close it. The data is looking like imports will be even lower than that in November. So we are starting to see supply tighten a bit. And of course, this does coincide with the, autumn outage season. So, mills have cut back on production a bit over the last couple of months. And with imports also being reduced, it has tightened the supply situation here in the United States. That said, there are a few things that doesn't make me that worried about supply. Utilization rates have not approached 80% really this year. We are right now we're between 75-76% utilization in the United States. And also we had some news today that US Steel Granite City was going to restart one of its blast furnaces. I think sometime in the spring. It takes a while, of course, to bring those back online. So that's restarting after 2 years of being idle. So we do have that. And of course, we've talked about this before, Tom, is that we do have still a lot of capacity coming online for, new facilities, greenfield facilities that are coming online between, hot roll coated, even rebar in the near term. We do have capacity coming online. That said, I think what's really happening, and we heard this through our research partners this last month, is that it's tightening right now because it needs time. Like supply chains need time to readjust. Maybe they were, pulling supply down from Canada, and now they need to readjust their supply chains. Maybe look more in the South, or maybe in the Midwest with this Granite City popping back up. But supply chains just need to readjust. So right now, I think the market is feeling some temporary tightness. That I do think will resolve itself as we, move into 2026.
Okay, a great summary and interesting to hear that more capacity on the way in the fairly near future. In recent months, we've heard that the Federal Reserve have made their first interest rate cuts for some time. I guess that's something else that will probably manifest in at a later date. But in terms of demand now, can you give us a little bit of a summary of how that supply situation plays into demand in the US?
Yeah, demand is steady, and but it's not necessarily anything to get excited about, so, and that's kind of what we hear from our research partners, is that it's steady but at a lower level than what people would like, or what people even expected coming into 2025. And I think unfortunately that is going to carry over into 2026 as well. But you have construction spending. On a nominal basis, it looks pretty flat. We're starting to get more data in from the US, our typical U.S. government sources. On a nominal basis, it looks flat, but we know that's not the case on a real basis, because inflation for construction materials is moving higher, or it's, I'd probably say between 3, 4, 5%, for inflation for construction materials. So you are seeing a real decline in construction spending right now. There are some bright spots which we've talked about in the past, and you can certainly read about in our International Steel Review. But of course, everyone wants to talk about data centers right now. That's certainly a bright spot for steel demand. There's also some infrastructure spending. And, now we're also hearing research partners talk about the border wall as well as another source of strength for steel purchases. But that's just not enough to keep the industry, going at a good clip. So I think that, I'll get back into interest rates and what that might mean in the near term as well. But, in auto sales are doing okay. We're not back to where we were pre-pandemic. We were running at an annualized auto sale rate of about 17.5 million. We're still around 16. Maybe we'll see more domestic production with the 25% tariffs on auto and auto parts. But for the most part, we're still sort of at a bit of a lower run rate on production for steel. And then you've also seen a little bit of a pullback given the EV tax rebates were pulled offline in October. So we are going to have a situation where demand is just a little bit lower than where we expect, and certainly not where the industry needs it to be right now. On the interest rate side, we are going to have, we expect that interest rates will be cut for the third time this year, and next week. So a 25% basis point cut is expected next week, in the second week of December, and that would bring us to 75, or 3/4 of percentage point cut this year so far, down to about a 3.5% interest rate for the United States.
Okay. So just to recap on the things that we've just been discussing there, how have these factors influenced pricing in the US steel market?
Great question. Actually, it did have an impact this last month on prices, particularly on the coil side. So, I mean, and the tightness in supply actually created a slight mini rally in coil prices this last month. We've seen that reflected in the CSP, Nucor's CSP price has increased about $45 since mid-October. The futures market for the January contract price has increased about $50 over the last month. And of course, our own prices, most importantly, have reflected this as well. Hot rolled coil prices on the low end, our base HRC price on the low end increased $50 this last month. Cold rolled followed a similar increase as well. Plate, it was flat this last month, but since around Thanksgiving, Nucor and other producers decided to increase prices $30 a short ton. We don't know what we'll have to wait until December to see if the market took that increase or not. But generally speaking, flat prices were up due to this constrained supply that we talked about earlier. On the long side, rebar was the only price last month to increase on the long product side. It increased on the low end $30, actually $20 on the low end per short ton last month. And that is a product that has seen out of all the long products, rebar is the one that has seen the most constrained supply, namely because we've seen a big reduction in imports. There was a trade case, not only the 50% tariffs, but there was a trade case initiated this summer for the top importers, and that we really started to see a pullback in imports, as well as we had expected some increased production through new capacity this last year, but some of that has been delayed, kind of furthering tightening this supply situation. So rebar is one to watch, but I am going to say one that Tom, talking to me, that I'm constantly following is beams. And interestingly enough, if you look at preliminary data for November on imports, it's almost like the importers have said enough is enough. These prices are high enough. I'm going to start shipping in. We, at least on a preliminary basis, imports for heavy structural shapes or beams recorded its highest level in like 10 months. So that's something to kind of watch, and certainly something we will be keeping an eye on here at MEPS.
Absolutely. Interesting insight. And I guess in light of that, a lot of people will be curious to know what our expectations are going forward. I certainly am, actually, Laura. We recently recorded the webinar related to our steel price outlook, which gives price forecasts right up until 2030. I'm not asking you to go that far here.
Yeah.
Just the next few months, what is the outlook in the US steel market?
Well, we do think that this mini price rally on the coil side is going to be short-lived. So this, you're going to need stronger demand for any price increase to truly stick in the market. And as I mentioned earlier, the supply situation is temporary. So we have prices for hot rolled, cold rolled pulling back by the end of the first quarter, not third quarter, first quarter. So a few months of stronger prices, and then pulling back by the end of the first quarter. On the long side, those have remained a bit more elevated than the flat prices, and we see those staying, being supported. Some of them have certainly been used very strongly in this AI boom, the data center side, and that is providing some support. We're not seeing prices increase much more than that, and I should mention that, and I kind of just did indirectly with the beams discussion, is that these tariffs do put an upper limit on how high prices can move. So, we'll have to watch the situation with beams, but prices can only go so much higher without, especially with where global prices are sitting right now, before you start to really attract imports. And especially with two neighbors so close to us that could import more product than they are right now, that does put, this upper limit on where prices can go. So for longs, they'll be elevated but relatively stable over the next few months. And for flats, we do expect them, at least on the coil side, to retreat a bit from where they are right now.
Fascinating and interesting snapshot of the early part of 2026. It's been an exciting month. Do you expect 2026 to be exciting then, Laura? Are you looking forward to it?
Of course, I'm always excited about the future. So I will say yes. I do hope that for real excitement, maybe volatility will certainly be a continuing theme, but I do hope that demand can return to steel markets as we move into 2026. At this point, we think that those lower interest rates that we talked about earlier will take closer to the end of the year to really take hold on the market.
Absolutely. And as ever, people can keep up to date with developments in the US steel market in the International Steel Review. So keep an eye on that.
Yes.
Great stuff. Thanks for joining me again, Laura. A great little market in minutes summary there. Thanks for your time.
Thank you. Till next time.